Well, good morning, everyone. My name is Stephen Flynn, and I'm a partner with Andersen here in Vancouver. And today's topic is the second in a series. It's called U.S. Expansion, Business Expansion to Canada. And I'm joined by my partner from Andersen in Montreal, Danny Guerin. Danny, welcome.
Nice to talk with you, Steve, and greatly appreciate the opportunity you lent me to have a discussion with you on this interesting topic.
Well, it is. And Danny and I have worked together in a few of these different situations. And I think what you find is the more you learn, the more you realize you don't know, and the more you try and reach out and get help. And so, Danny and our Montreal office have been a great team to work with over the years and filling in some of the gaps and knowledge we don't have and helping, create structures and create solutions for our clients that are just better than, they continue to improve, if I will. So the next slide there, we'll talk a bit about kind of some of the details here, but just in terms of some of the things for today for our webinar. For audience participation, we have a series of polling questions. Those questions are designed to make this hour count towards your professional development, your professional learning credits. And so we'll issue those CPE credits later. We'll have 3 polling questions throughout this. The answers will pop up, the potential answers will pop up. You can just click them. If you've got questions as we go through the material, and some of you have already submitted those questions, and thank you for that, please type them in the box below there. We've got Kenneth Tango and Shan Lu who are going to monitor those questions and prompt them at the end. We're going to try and allow 10 to 15 minutes to try and field as many questions as we can. At the end of this, you'll get a survey, and those surveys are important to us. This particular topic and some of the offshoots and the series of it come from the input from our audience, and so we really appreciate that. And if you want to actually see the audio in print, there's a closed captioning option there. If you just click on the CC button, you should be able to read what we're saying today in real time. So thank you for that. Next slide there. So this is part 2 in a series. This is a part of our BizTax series. Last July, my colleagues Adif Mir and Namir Halleck started what I'm going to say was the first part of the series where they talked about Canadian businesses expanding to the US. And we envision kind of a multiple parts to this, because as you go through it, you'll see there's all sorts of different nuances and details and opportunities and pitfalls when you try and structure businesses between both Canada and the United States. And so today, what we'll do is part 2, which is really focusing on what I'm going to call northbound or US businesses expanding to Canada. I'll talk a bit about some sample structures that you might have based on different scenarios. Danny's going to talk a bit about some of the concerns over debt financing and how Canada looks at that. We'll talk a bit about some of the strategies and pitfalls when you want to actually take profits from Canada and repatriate them to the US. And to the extent we have time, we're going to talk about some of the Canadian tax implications when you exit and finally sell that business. So full pack agenda, let's get right to it. So the first slide there. So what we did is we created a couple situations here that we see quite commonly, and we'll show you some sample structures. These are at a fairly high level. And anytime we go through this process, before we can even put pen to paper and draw a structure, we got to ask questions. We got to figure out, what's that client fact situation? And we're asking a whole series of questions, and everything from the residency and the citizenship of the investors, the type of entity they're investing through. They might invest personally. They could invest through a corporation or some alternative structure. We want to understand the business itself. Is it going to be profitable right out of the gate? Are there going to be losses that we may want to use for the investors themselves? Are there, other different factors in terms of third-party payments, in terms of agreements, in terms of, looking at where taxation and tax rates are between the two countries? And then we start to think about profits, say, well, where should profits be taxed? And then when you think you've got it settled and you think you got a good structure, you got to, take a look at all the different tax rules and anti-avoidance type provisions that both countries have, and make sure you've got a solid structure that anticipates as many of these possibilities as you can. So I came up with 3 kind of sample ones here. The first one would be a very simple one where your investors are all US residents or US persons, or it's US entities and they're investing into a Canadian business. The second one would be a mix. We often see that there might be an operator in Canada and they want to bring that operator on as an investor, and maybe it's a significant investor. So you might have a mix of US and Canadian resident investors. And then the third one is a nuance we see more and more, which is you might have something similar to what I just described. However, some of those Canadian resident investors may also be US citizens or US persons. And so you got to, think through that piece as well. So next slide. So in that first situation, so the first situation I described to you is just simply all US investors. And what would it look like from their perspective? And so one of the questions on the left-hand side would be to say if it's just a very vanilla plain investment and it's two US corporations, the rectangle shows that they're corporations perhaps, and they come in and they invest in a Canadian business, it might just be as simple to have a regular Canadian corporation. You'll have profits taxable in Canada, you'll pay income tax, you'll be able to pay dividends or management fees or other things to the US investors to bring back profits. And we'll talk a bit about that as we go on. Simple, straightforward. It has some downsides to the extent that you have losses from that business. Those losses would stay in a regular Canadian corporation. They couldn't really be used by US investors. You may have, when you flow through Canadian taxes and dividend taxes, your overall tax rate may be higher. In general terms, Canadian corporate tax rates would be approximately, say, 27%. You got to add a dividend tax to that, which could bring you close to 32%, depending on your effective rate. And then, your US corporate tax might only be 21%. And so you may have more Canadian tax payable than US tax. And so this structure can be effective. However, you got to ask those questions I said is, what are the investors? And so on the right-hand side, when we asked those questions and found that, well, one of the investors is actually an individual in the US, we then said, well, maybe there's a different structure we could use here. And one of the more common things we see for American investors coming to Canada is something called a Canadian unlimited liability company. They've been around in Nova Scotia law for 100 years or more. They're somewhat new in the last 20 years to Alberta and British Columbia. Those are only 3 provinces that allow them. And the idea here is that under Canadian tax law, they're really no different from an income tax perspective. It's the same rate, it's the same provisions, the same act. The legal difference is that unlike a regular Canadian corporation that would protect investors from liability issues, an unlimited liability company has no liability protection. And so anything that happens in the business, any kind of lawsuit and claims could be, pierced through the corporate veil, if you will, and the individual investors could be at risk. And so in our situation here, we have a structure to protect the investors. And so you'd say, well, what's the difference from a US perspective? The biggest thing is that from a US tax perspective, an unlimited liability company is considered a disregarded entity or a flow through for US tax purposes. So basically, whatever happens in the entity, it's as if the investors, it happened to them themselves. And so it has some advantages in that income and losses and foreign tax credits flow through directly to the US investors as if they did it themselves. And there can be an efficiency in that your overall tax rate could be lower. And also you might see a situation where if you've got losses, they can be used by the US investors. If you like, there's some flexibility under US law. An unlimited liability company could also be a corporation. If you wanted it to be that for US tax purposes, you just need to file an election under US law to make that happen. And so you've got a lot of flexibility using ULCs. Danny, I'm guessing in your practice, you see ULCs quite often, do you?
Yeah, we do. But one important thing with the ULC that it provides for flexibility, but as you're probably going to come across it, there's certain pitfalls using that sort of structure, because even though from a US perspective, the ULC will be seen as a flow-through entity most of the times to take advantage of the flow-through treatment of, let's say, losses in a particular case. From a Canadian tax perspective, it's still considered or regarded as an actual legal entity that's liable to Canadian taxes, so in its own shell, if you will. So and that duality in terms of treatment of that specific entity and you probably expend a little more later, creates sort of a headache in terms of the application and the granting of any treaty benefits, potentially depending on how the ULC is treated. But
I think
yeah,
that,
that's something we use. That's something we use quite often in situation where you're going to have losses in Canada, and we can always also use have just a branch basically in Canada for that U.S. entity. So that's the other option you have to, have that alternative to flow through the losses to the U.S. more efficiently.
well, I think it's well said, and I think what if you can hear it in Danny's words, when we talk about part 3, 4, and 5, and 6 of these webinars, I think Canadian unlimited liability companies is its own full, complete topic. When you talk about treaty restrictions and concerns over planning, we will barely scratch the surface of that in our session today, but I think that's another one we could add later. So, next slide. So now in our situation, we've introduced a potential of a Canadian individual who might be part of the investment group. And it's similar to what we had before. To help that Canadian individual protect them from liability, we'll put in something called a Canadian Holding Corporation. And so it protects them from liability. Canada's got an integrated tax system so that the operating company in this situation, the unlimited liability company, it could be taxed on the profits. And so long as the individual through their Canadian holding more than 10% of the shares of the unlimited liability company, dividends between the operating company, the ULC, and the holding company would be paid tax-free. And it gives the individual a benefit to receive profits on an effective tax basis, but still protect them from liability. And in this situation, what's important is the question we ask, which is for that individual who lives in Canada, are you a U.S. citizen or not? In this case, they weren't, so this is an effective strategy. Now, if they were a U.S. citizen, one of the concerns we'd have on this strategy would be that Canadian holding company would be subject to some anti-deferral rules under U.S. law. There could be anything from what's called the Subpart F rules that can attribute and mistime passive income into the individual's hands and can increase tax rates. Or if that wasn't bad enough, something called the Global Intangible Low Taxed Income Rules, or the GILTI rules for short, could also apply to that U.S. citizen. So there has to be some caution using a Canadian holding corporation. So when you get U.S. citizens that are investors, and if you can go to the next slide, you may use a totally different format. And one idea here, and it really depends on the business and does it make sense and is it effective and how active the participants, you got to ask all these questions, but you may want to consider a Canadian limited partnership. And the advantage of a Canadian limited partnership is that, and to the extent that you can protect liability here, its taxation rates are going to be different. The profits are going to be taxed to the individual as opposed to the corporation. So you don't get that nice deferral of taxation that you might in Canada. I haven't drawn that there needs to be a general partner here, so there's some other nuances in this. But to the extent you can flow through the partner, the income to that U.S. citizen individual, this may be an appropriate structure because they're not subject to these anti-deferral rules because there is no corporation. From the U.S. investor's perspective, we can still use that Canadian unlimited liability company, but it has a different role in this structure. It has the role of the holding company as opposed to the operating entity. The operating entity here would be the Canadian limited partnership. And the reason for the unlimited liability company is that to avoid some of the rules in Canada that apply to what are called non-resident partnerships, you want to have all your partners in a Canadian partnership be Canadian residents, and a Canadian unlimited liability company would be a resident of Canada because it's a corporation formed in Canada. So this could be effective to flow through it. And we might see things like real estate investment that might be a good business for something like this. We might be able to see operating investments that might work here. It really just depends on the facts and circumstances. So lots of information there, just some sample structures we might look at. If you want to go to the next slide, I think we're at our first polling question. And the question, it'll pop on your screen there, is for a Canadian unlimited liability company, the question is for US tax purposes, what is it? Is it a disregarded entity? Is it a partnership? Is it a corporation if the election's made? Or is it all of the above? Danny, I'll tell you a funny story about British Columbia and unlimited liability companies. When they were formed, I want to say it was 2004, and this is part of the documents that the British Columbia government publishes, and it publishes all the different legislation changes and all the other items. But there's a question and answer that says, why did the British Columbia government form unlimited liability companies? Why did they allow those legislation? And the answer is one sentence. And the one sentence is very clear, and it says, for US investors. That was the only reason the British Columbia put that in. So
That's a good one.
yeah, it is very odd. So a very mixed response here. And I can understand that because for the first three answers, you're right. Any of them, it can be a disregarded entity. It could be a partnership if you got two or more shareholders in a ULC. If you choose to make a corporation election under US law, it could be treated as a corporation. So the answer really is D, all of the above. So as we go through this, one of the things that, and I'm going to turn this over to Danny a second here. One of the things you often see is we've decided a former entity, and now how are we going to fund it? How are we going to fund this operation? And oftentimes we'll use some form of debt to do that. So Dan, I'm going to turn this over to you to talk about some of the Canadian tax
Yes.
implications on using debt.
Yes. Thanks, Steve. To add to Steve mentioned, whenever you're gonna set up your Canadian structure, if you're a non-resident, there's ultimately two ways to fund your Canadian operations or your Canadian subsidiary. You either fund it through debt, through equity, or through a mix of both debt and equity. The advantages of the debt or the equity are various, and there's differences in each of them, and they all accomplishes the different objectives and different intentions, basically. But all that to say that whenever you're investing hard cash as equity in your Canadian subsidiary, you being a non-resident, you'll be able to extract that investment, which is called PUC, paid up capital. So you'll be able to extract that from Canada. So Canada will be able, your Canadian subsidiary will be able to return it to you free of withholding tax, return a PUC. Whereas whatever you're going to be generating as profits, after-tax profits in that Canadian subsidiary, if ever you want to distribute it as a dividend, withholding tax would be applicable. If you turn to, so all that to say that PUC is really an appreciable asset from an extraction or repatriation perspective. When you compare it to that accomplishes an other step more, if you will, or there's another important advantage with the capitalization with debt is that not only you're able to basically on repayment of the loan from the Canadian entity, there wouldn't be any taxation applicable, but also on interest payments made from the European sub to the parent, the non-resident parent, specifically the U.S. In that specific case, withholding a tax that is applicable under domestic law, the Canadian domestic law. It basically exempts most of the interest payments that are made with arm's length entities. But it also, if you go through most of the treaties now that Canada signs with other countries, namely with the U.S., is that with even non-arm's length payment of interest would not be caught under the withholding tax regime. The withholding that normally applies under domestic law, 25%, would be exempt under the treaty. So you get that return free of withholding that's comparable to your equity contribution or your capitalization with equity. But you also get, going through that route, you also get a potential deduction of the interest expense that's paid to the U.S. When you're computing your Canadian taxable income. So it creates a deduction, so it reduces your Canadian taxes of your Canadian subs accordingly, and makes the whole exercise more tax efficient from a global perspective. So that's the other element that's important. So Having that said, obviously that would probably push most of non-residents who are in that sort of structure to basically try and maximize the amount of debt that they want to push to their Canadian sub to have that specific situation where you're going to lower your Canadian taxes while being able to extract what you need to extract withholding tax free.
So Danny, it really sounds like a great way to repatriate profits and investment because of its debt. You can effectively repay the debt tax free, but if it's also interest, you're stripping money out of the country in Canada, not paying tax, but also avoiding withholding tax. So a really good strategy to take profits on, I'm guessing.
Yeah, an excellent strategy, and that's why the Canadian government just jumped on this all over this not this like loophole. I wouldn't say a loophole, but this like little gap that was in the act back then. So they basically adopted the thin capitalization rules, and essentially the thin capitalization rules are designed to avoid having like this specific scenario. So having a
So sorry
non-resident.
just to interrupt. We should just go to the next slide there. Go ahead.
Oh, yeah, thanks. So if you look at the graph on the right, so as mentioned, the thin capitalizations rules were meant to avoid having non-residents loaning money to related Canadian entities and basically taking advantage of that system. So the Canadian government just had put together certain thresholds that they wanted to be respected by the creditor in terms of what was the proportion of the ratio of in terms of leverage that was basically put into its Canadian sub. So those thresholds or those rules where you're going to be limited in terms, and I'm talking for the Canadian entity. The Canadian entity will be limited in terms of the deduction of interests that it will be allowed to deduct to that specific ratio, the 1.5 to 1, which is a debt to equity ratio. So for those who are more like more from a straightforward perspective, it would probably be looked at a 60-40 ratio, so 60% debt, 40% equity. So that's the maximum that the non-resident in that specific case would be able to actually put or contribute as debt into its Canadian sub for the sub to be able to deduct the related interest. And it's important to note that those rules apply in certain specific situations where the loan in question or the debt was actually issued from what we call the specified non-resident shareholder. So that restriction is applicable to any amount that is owed to specified non-resident shareholder, as well as any non-resident persons that do not deal at arm's length with such specified non-resident shareholders. So what is a specified non-resident shareholder? In a nutshell, a specified non-resident shareholder is a person that's non-resident Canada, obviously, but that is a shareholder and that owns shares together or, alone or together with persons not dealing at arm's length for at least 25% or more, be it in terms of votes of the Canadian entities that would be subject to those rules, or the value of all the outstanding shares of that Canadian entity. So if you're in a situation where you have a non-resident that lent money to its sub that's 100% owned by that non-resident, then automatically those rules would kick in, and you would need to compute that specific ratio to see if you're in excess of that ratio. And if you're in excess of that ratio, there's going to be an interest deduction denial. And I'll further down the road, I'll explain the other consequences. There's a little note on the the end of that slide that basically mentioned that well, I wouldn't say recently, but a few years back, CRA or Canadian government put together certain patch to the existing thin cap rules to make sure people were not we're curbing out of those rules within certain strategies in terms of having intermediaries that were inserted into a loan scheme to ultimately avoid the application of the thin capitalization rule. So in a nutshell, the back-to-back loan rules are essentially put together or meant to as a specific anti-avoidance rule to make sure that certain non-resident shareholder that would be considered specified non-resident shareholder in that case would not be lending an amount to a third party intermediary in exchange for an agreement under which the loan would be then reloaned to the Canadian entity that, if it wasn't for that third party insertion or intermediary, would be caught under the thin cap rule. So those rules were essentially meant to basically make sure that the non-residents that would be caught by these rules would not curtail the application of such rules in that specific case. So next slides, please.
Yeah, so I think it's really important as you go to the next slide here, and Danny will go through an example here that there's a limit. I mean, debt's very attractive because of those flexibility things we talked about, but Canada said, and the US has the same rules or similar rules that say there's a limit to how much debt you can put in, and we're going to make it very expensive if you hit those limits. Danny, go ahead with the example.
Yep. Here's a very graphic example of how those rules apply. So if we take the initial situation that was reproduced earlier on, we see in that specific instance that the non-resident company invests equity, $100 of equity, and loans $200 of loan at the 10% interest. If it wasn't for the thin capitalization rules, we'd be in a situation where Canco would be able to deduct basically for year one $20 out of its $200 loan payable to its non-resident parent. Now, if you apply the thin capitalization rules, if we look at the ratio that's initially to be considered, in this case, we have $200 of loan and $100 of equity, so it's 2-to-1. So that 2-to-1 ratio obviously exceeds the limit of 1.5. And for your information, the computation of the disallowance of the interest deduction is reproduced there. So it's essentially the total debt amount that you're going to have with that the non-resident specific shareholder will have with its Canadian entity, less 1.5 times the equity amount that specified non-resident shareholder will have in such Canadian entity over the total debt amount of the entity in question. And that excess, in our case, if we look at the far right hand side of the graph presented above, it's gonna lead to essentially a refusal or a denial of $5 out of the $20 total that was included, or I should say deducted from Canco's taxable income. So that $5 would be added back into Canco's income. It would be refused as a deduction. Not only that, but there's an other element to consider that wasn't there at the beginning of the introduction of the thin cap rules, and it's essentially the fact that $5 would be deemed under specific disposition of the Act as being a dividend having been paid to from the Canadian entity to its non-resident shareholder. So that would obviously attract withholding tax, depending on the and in that specific case, depending on which type of entity the non-resident is and the Canadian entity is. If it's if they're able to access treaty, then obviously the withholding rate would be 10%. So we would be looking at out of $5 dividend at 50-cent withholding.
And I think this is a really important point. Anytime I see that phrase disallowed interest, that causes me some concern because, Danny, I understand this isn't a timing issue, correct?
Exactly. It's a perm issue, and it causes, like, not only does it causes issues from a tax accounting standpoint, but it also causes issues in terms of cash flow, because what happens is not only Canaco is not able to deduct its $5, it's going to pay tax on that $5, but it will also need to withhold, a portion of that amount and remit it to the Canadian government. So from a global perspective, the non-resident entity would be left with less money than they would have had if it wasn't for that whole deduction denial, basically.
Right. And I think it's an important one to note that, anytime in a cross-border situation where if you get a denied expense in one country, as Danny's showing here in Canada, but if in the other country, in the US, this interest is still taxable, you've got a potential of mistiming, and Danny's going to talk about that, and a potential of taxation twice in the same income.
Yeah. So if you go to the next slide. Yep. Before going through the potential timing mismatch, we need to understand how the debt to equity ratio is actually computed. So the 1.5 threshold, 1.5 to 1. So how do we go about computing the debt amount that goes into that specific formula? So the debt, if you could just go back, the debt amount represents actually the highest amount on a monthly basis. So each month you're going to compute the highest amount owing that was outstanding to be paid to the specific or specified non-resident shareholder by that Canadian entity. So you're going to compute the average of the highest amount during the month that was owed. So that's a specific point in time. As for the equity, which gives you the actual relief in terms of the deduction, the way to compute the equity, one important thing to note before going to the computation is the only equity portion that will count towards that ratio is the equity that the non-resident shareholder actually contributed to the Canadian taxpayer. So if you're in a situation where, let's say, you're having a multi-tier or multi-layer structure where you're going to have, take, for example, a non-resident entity that will have a Canadian sub that would have, let's say, another Canadian sub. If that non-resident entity was to loan an amount to the second layer or second level Canadian sub, basically on that specific loan, even though it would be considered a loan that would be subject to the thin cap rules, the equity amount would not, there wouldn't be any equity amount, basically, because the equity would have been put directly from the first layer Canadian entity. So that's something to also bear in mind whenever we're actually considering loaning amounts through a structure. If we're in the situation where those rules could be applicable, it's to consider that specific instance and make sure that if ever you want to flow cash from the top to a lower level subsidiary, to make sure that you're actually loaning all the way down to make sure that the equity that you actually put is basically considered in the computation. But to go back to the computation, the equity, be it contributed surplus or paid up capital, will be the monthly average at the beginning of the month. And the beginning of the month doesn't mean the first day of the month. It means actually before that first day. So if you're putting $100 of hard cash as a contribution of capital or paid up capital in a Canadian sub, it will count towards the month following. So that's an important timing to consider. It's for both contributed surplus and paid up capital, they're the same. So they're computed the same. As for retained earnings, Retained earnings is the beginning of the year retained earning balance. And a couple of elements to consider that are important is the retained earnings are those that are computed as reference to with the Canadian GAAP. So there's, financial statements retained earnings, but they're standalone retained earnings at the same time. You cannot have consolidate or consider consolidated retained earnings. And an important thing to note, if you're in a deficit, you don't count deficits. So that's a plus. So that's the way to compute the elements that are part of the ratio that's needs to be computed in terms of getting to the amount that would be denial from an interest deduction perspective. Then, I probably referred to a bit earlier, but there's obviously a timing mismatch potential, and we're going to show it in the next slide. So if we take this this very example where we're having a non-resident company that on Jan 15 of this year, at the same time it invested equity at $100, it loaned an amount of $150 to its Canadian subsidiary. So the relationship would lead to the conclusion that potentially the loan would be subject to thin cap. But if we look simply at the ratio, it seems like we're fine. We're at 1.5. However, due to the fact that the computation of both the equity and the debt are different in nature, where your debt will be computed by reference to any amount that is due during the month, the highest balance of which would be considered your equity, not equity, but debt amount outstanding to owing to specified non-resident shareholder. It's not the same for the equity. So that would mean that for the equity, the month of January would not be counted as a month during which the equity was actually put in. So if you look at the computation, so we're seeing that we have a debt to equity ratio of 1.5, but if we actually go and compute properly for each month, that's taking for as an assumption that that situation didn't change for the whole year. We would have a situation where at the end of the year, there would be 1 month where the equity of $100 would not count, which would lead to basically a leakage in terms of the actual ratio. And we wouldn't have a 1.5 to 1 ratio, but we would actually have a 1.64 over 1 ratio that would lead to a denial of deduction of I can't remember the amount, but it's a small amount. But it's important to bear that in mind whenever we're advising people or we're actually trying to put together a structure where we're going to have both equity and loaning amounts to Canadian entities. So that's something to bear in mind.
I think that's right. And I think one of the things that's really important from this example is the idea to model out what you're going to do, because as Danny says, if we think we're in line with the 1.5 to 1 ratio, we may not be. So next slide. I think it's time for our second polling question. And Danny, I'm going to get you to read this one.
Yep. So Canada's thin capitalization rules outline the maximum dollar of allowable intercompany loans, a limit of the ratio of debt to equity that dictates allowable deductions for intercompany interest, or ask your doctor about Ozempic.
And whoever created the question here, which I'll admit is me, probably watches too much sports on television, and these ads are a bit of an earworm. I think when I got to go back to the thin cap rules, the U.S. has some similar rules. They apply very differently, different rules, different ratios. But the biggest thing I always observe is the U.S. might give you some timing abilities, but Canada seems to have a permanent deduction. So as you can see there from the answer, yes, there's no maximum dollars that are here, and no, you don't have to ask your doc about Exempic. It is a limit of the ratio of debt to equity that gives you allowable interest. So thank you for that. Our next slide. So just in the interest of time, we got about 5-7 minutes left. So we're going to kind of go through some of this stuff. As you can hear, there'll be parts 3, 4, 5, 6, and 7 going forward, and we're excited to have more in this series. When you start to think about repatriation of profits, there's a number of ways to do it. We talked at some depth today about interest payments and some of the concerns there. There may be other ways to make repatriate profits from Canada to the U.S. There may be with license agreements or any kind of other intellectual property agreements that would result in royalty payments. And so the caution with royalty payments, particularly with related or non-arm's length companies, is that those royalty payments should be dictated at arm's length terms with reasonable prices. So these are part of the transfer pricing rules that both Canada and the U.S. has, and they're designed to make sure that there's a fair trade and a fair price between two companies that would be not arm's length, pardon me. And depending on the nature of the royalty payment, there may be withholding taxes. If it's payment for intellectual property or a license or a trademark, there could be a 10% withholding payment under the Canada-U.S. Income Tax Treaty. Next slide. Other ways to think about it, we talk about dividends. In particular, there's some special rules that we need to be mindful of when it comes to dividends with unlimited liability companies. Unlimited liability companies have a status under the Canada-U.S. Income Tax Treaty. They're what's considered a hybrid. So it's a corporation for Canadian tax purposes, but it's a disregarded entity, as we heard in our earlier questions, for U.S. purposes. So it's got a different characteristic. And so there are some anti-avoidance rules in the treaty that would say that if you're using these types of hybrid entities, you may not get treaty benefits. And in fact, where we might think that's a 5 or a 15% rate of tax, it could be as high as 25%. That's the statutory limit under the Canadian Income Tax Act. So one of the strategies to help here is and Canada Revenue has effectively approved this, is to go through a bit of a two-step process. And this is also probably in that full series on ULCs. The idea is that you would raise your capital, you'd actually increase your stated capital, which is a dividend. You'd then redeem that capital. When you go through this series of transactions, it doesn't get you to the 25% rate, it gets you to the 5 or 15% rate. So it gets you a much lower rate. So the key is, without proper planning, using a ULC could result in a very high withholding tax rate, probably the highest you might see on payments. Go
if I may add, Steve, another important point. But as mentioned before, we were saying that repatriating profit through, let's say, interest payments that weren't necessarily caught under the withholding tax rules. Well, if you're a ULC in that specific case, and you would not be, you'd be a disregarded entity from a U.S. perspective, then that whole point about going through debt and would probably be a little less attractive, because you'd be in a situation where you wouldn't be granted treaty benefit, and ultimately you would be ended with like 25% of withholding tax on that. So I just wanted to add that to our previous discussions about the attractiveness of having interest payments from Canada to the U.S.
Absolutely. So other ways then to repatriate profits might be management fees or some sort of intercompany charge. Perhaps the U.S. company is providing services to the Canadian subsidiary. It may be executive oversight, it might be accounting or finance or research and development or marketing. And so some portion of those costs that are borne by the U.S. company should be charged to Canada. In general, that does not attract withholding tax. The caution is always to make sure those prices are reasonable in the circumstances. Again, we go back to the transfer pricing rules, and companies should have some sort of policy, some sort of standard, some sort of methodology that's provides a fair price, a reasonable price, as if two arm's length parties were going to negotiate that. And the other way would be to simply go through a repayment of the existing debt, or in circumstances that might make sense, a return of the capital. Those generally can be done on a tax-free basis. So we'll go to our final question here. And so the highest withholding, this is a little more technical, the highest withholding tax rate on payments to US investors is, and it's one of four things, it's either on interest, it's on management fees, it's on dividends to individual shareholders from regular corporations, or it's from dividends to US shareholders from Canadian liability companies without proper planning and director resolutions. And boy, I know when I was in university and I would look at multiple choice questions, when I would see something like this and it would say something like without or except or always or something like that, that was either the one you chose or you never chose. Been a long time since I've written a multiple choice exam, but
Steve, have you written your USCP exam?
it was not in this century. But yes, I have.
So,
But it
so,
was,
so,
and
okay, so you're used to multiple choices
it, it,
questions.
it, it was a multiple choice exam, and I probably I don't know if I studied too hard for it, but I remember coming out of the exam thinking, well, I've had university exams harder than that, but there was a discipline certainly when you did it. So great to see. As I said, the answer here is without proper planning and techniques, the Canadian unlimited abilities can have a 25% rate, and that could be some of the highest rates. So that's great. So we'll keep going here, and we're at quarter to the hour here. And Danny, I'm going to put you on a tight time frame here. We've got some slides here on Eiffel and guarantees. I'm going to give you 5 minutes to go through them. So
Okay, I'll do the best I can to go
sure.
through this as fast as possible. So the excessive interest in financing expense limitation, the IFEL rules, they were introduced as part of the budget 2021, and following obviously a report that was issued by the OECD Action for the BEPS initiative, so the base erosion profit shifting initiative that was initiated by the OECD. So Canada finally accepted to follow the guidelines that were issued by that international entity, and this specific rule is basically a rule that would limit the deductibility of any interest in financing expense to a certain threshold, which is based on a percentage of what is mentioned there as adjustable taxable income, which is in essence the tax EBITDA, so earnings before interest, tax, amortization, depreciation, and basically the 30% that's mentioned there is for taxation years of eligible group entities that would be subject to this limitation that starts after the end of last year, so after 2023. That there's transitional rules for taxation years that started from October 1st to December 31st of 2023, where the government granted, instead of 30%, it was 40%, so an extra 10% of deductible interest and financing expenses. But most of our cases, I just got a few clients that basically were within that specific window, but it's very rare. So those rules were actually included as part of Bill C-59 that's currently sitting at second reading in the House of Commons. So I don't know, the House of Commons probably busy with budget now, and the whole government is looking at this. So where the bill will be, we'll only see in following the budget, I would assume. But for now, it's it's currently sitting in the House of Commons. So next slide. So who are the targeted entities for this for these set of new rules? Just to take a minute, those rules are very, very complex. They're a set of rules that includes, like, I would say, tens of more than 40 definitions that are very complex, and they're intertwined together, that all of them acts in concert. So you need to be very careful when you look at those rules, but that's why we're there to help you with these. And they apply to persons that are not natural persons or partnerships, essentially apply to corporations and trusts, other than those that would be considered excluded entities. And one point to note is that the IFEL rules, they apply not only in a non-arm's length financing situation, but also from an third-party financing. So all the interest and financing expense could be limited depending on the level of tax EBITDA that an entity will have, and provided that the entity is not an excluded entity. It's those rules are similar to, if people are familiar with the 163 1J U.S. limitation on deduction of interest. So it's, you know, a similar concept that was introduced by the Canadian government in its past year's budget. So to finish with that, there's certain exclusions for entities that are part of what we call, that are small CCPCs, so Canadian controlled private corporations, that have less than 50 million of taxable capital employed in Canada for the preceding year. There's a de minimis threshold where if, you know, eligible group entities of a group have net IFE, so net interest and financing expense less the interest and financing revenue. If that amount, that net amount is $1 million or less, you know, the entity would not be subject to the IFA rules. And there's a domestic exception whereby if you're all the entities of the group that would be eligible group entities, so entities subject to those rules, have their activities or business being carried on all or substantially all in Canada, and they don't have what we call significant tie with foreign jurisdiction, which means that they don't have investment in foreign affiliates, the cost of which, either the greater of the cost of which those investments, or the fair market value of all the assets or properties of those foreign affiliates is less than 5 million. So if you have these two conditions, plus another one that's a bit trickier, but those are the two that we look most on. So if you're able to get there, you're gonna be excluded from the entities that are subject to those new rules. So an important point to determine if you are targeted by those rules is you apply the exclusion first. It's a you start with a small CCPC, the de minimis, and the domestic. So if you're not meeting each of them, you know that you're going to be facing those new rules, and there's probably going to be impact for you. Yep,
Excellent, Danny. Danny, I appreciate that. So just in the interest of time, and I know we want to make sure we leave some time for questions here, if you could go to the next slide. Actually, go to the guarantee slide, if you don't mind. Perfect. Danny, you want to talk a little bit about this?
Yeah. In the current economic situation that we're facing, you know, it's pretty hard, and you're going to have a situation where a non-resident corporation might want to finance its Canadian operations because it's not, you know, going too well, or it can even guarantee a loan that the sub would be getting from a third-party lender. So we just wanted to bring to your attention, so if that's the case, whenever your non-resident related party parent corporation would be guaranteeing a loan to its Canadian subsidiary, and it would be receiving a loan fee in exchange of that guarantee. It's important to note that those fees would be subject to the transfer pricing rules and would need to obviously be in accordance with the arm's length standards. So they would need to it would need to meet those guidelines. So essentially, that those fees that would be charged from the U.S. would need to be equivalent to fees that would be charged from a third party to that Canadian entity. And it's the last point that I think it's important to bear in mind is that specific guarantee fee for Part 13 purposes, and only for Part 13 purposes, it's considered as a payment of interest. And obviously, as we've discussed in great length before, if it's payment of interest, there's a lot of leeway in terms of being able to potentially avoid Part 13, but it's something to consider whenever you're actually charging guarantee fees to your Canadian sub. Yeah.
I think that's great, Danny. I think it's just another way to repatriate profits. Just be mindful of transfer pricing. If we can go to the final slide, and I would have suggested when I put these together in the weekend, Danny and I talked. I kind of suspected we were going to run short on time, so this becomes part three or part four, somewhere down the road. We'll talk about some of the taxation implications of the sale of a business. We'll talk, in a future session about what it means to sell assets versus shares, how goodwill's treated. We'll talk about the tax rates in Canada, how you best function that in the US. Next slide. The other thing we'll talk a bit about is the importance of due diligence. When a buyer's coming to look at a company and they buy the shares of the company, they're taking over the liabilities. And so from a tax perspective, they're looking at income tax, they're looking at sales tax, looking at employer taxes. They're making sure that that corporation did everything it was supposed to do. And if it didn't, that's when sales can get held up, and that's where money's going to be placed in escrow until problems are fixed. And we'll talk a lot more about that in the future. To our final there, as I said, we hope you complete the survey. This is how we can get better at things. This is to hear more topics. We've got some questions, I think, and so let's get to those. Go ahead, Kenneth.
Thank you, Stephen and Danny. So we do have questions from our audience. So our first question is, the thin capitalization rules in Canada, who does it apply to?
Yeah, great question. As mentioned before, the thin capitalization rules would apply to a Canadian resident entity most of the time that would be owing amounts to what we call specified non-resident shareholder, or any non-arm's length persons that would be related to such specified non-resident shareholder. So whenever you're having a loan that are between such parties, then the thin capitalization rules would apply. And then you need to make sure that your debt to equity ratio is within the prescribed limit of 1.5 to 1, so that you do not have any denial of any interest deduction that would be claimed at the Canadian sub level, or Canadian entity level, I should say, and that there's no potential of having a withholding tax on that deemed dividend that would be represented by that deduction denial, basically.
Thank you, Danny. We have another question here from our audience. When a business earns income in both Canada and the US, how do we structure the business in a tax-efficient manner?
I've heard this before, and we see this from time to time where, if you go back to some of those scenarios I went through, and you've got an investor in Canada and an investor in the US, and they're both active in the business, and they say, well, we're going to actually have a couple of people in Canada, and they're going to do this work, and you know what, we're going to have an office in the US, and we're going to do this work. And so it's two different businesses. And so you're now trying to solve not only how is the investment looking in Canada, but how does that Canadian invest in the US? And you got to be very careful, because a US business, which, if you just looked at US owners and said, well, it's private company, it's individuals, we want to make sure we got flow through treatment and partnerships. So they come up with something like a limited liability company, which works great for US persons, but doesn't for Canadian resident investors, because Canada treats a limited liability company or a limited liability partnership as a corporation. And so you get a different result. You don't get taxed on income, you get taxed on cash distributed. You can end up with high rates, double taxation, and a poor structure. So you try and find other ways for that Canadian resident individual, that Canadian resident investor, to invest in the US. And it could be a limited partnership structure, it could be a corporation, it could be a bunch of different things. And you're asking questions about, again, what's the business, what's the nature, what's the funding of it, what's the potential for losses early years, what's the potential profits down the road, is it going to be an exit that involves a sale of the assets, the shares, some combination. So it's certainly nuanced and much more complex than the structures I was showing. I think we've got one more question here. Go ahead.
Last question from the audience. When both thin capitalization and the new IFL rules apply, which one takes precedence?
Very good question, Kenneth. The thin capitalization rules takes precedence over the IFL. So you first when you're looking at a particular fact pattern or situation, you're going to first apply the thin capitalization rules. And if ever there's adjustments that are made via the application of those rules, the denial of interest would need to be considered when you then apply the IFEL rules. So it's important to have that in mind whenever you're going to apply the new set of IFEL rules that are coming forward pretty soon.
That's terrific, Danny. Hey, thank you so much, Danny, for joining us. Really appreciate that. I know it's a busy
Same
time of
here.
year for us, but really appreciate that. On your screen there, you'll see a QR code to our next webinar. We're going to take a little bit of a break in March and April. We're going to come back middle of May with estate tax planning for Canadians and U.S. citizens, back to our Tax 101 series. Thank you all for attending. We appreciate it. Have a great rest of your day.
Thank you, guys.